Hi, it's Steve from Snap Projections to provide an overview of our new Monte Carlo tool. I'm going to be using a sample scenario for John Snapper, who's currently 59 years old and looking to retire at 65. I entered all of my base plan data in the scenario setup. Then I proceeded to the planning pages where I entered in his RSP contributions and TFSA contributions. Once I was done with the base plan, I then clicked Recommendations at the top of the page and clicked Financial Recommendations to calculate the optimal strategy for his unique plan. Snap determined that I was best off deferring government benefits, CPP and OAS to 70, setting a taxable income target of $58,000 per year, and topping up his TFSA from the non-registered account. I applied that to the plan, and that resulted in the financial recommendation scenario that we have now. We can see the results of the plan. We have our taxable income target. We have Snap withdrawing from the RSP and non-reg to fund that. We have the TFSA top-ups occurring all the way down throughout the plan. And then once the non-reg depletes, Snap withdraws from the TFSA at the end. And we have a very tax-efficient final estate of about 1.4 million plus the principal residence. So the plan looks excellent based off of our base assumptions. So if the client does receive 4.4% per year every year going forward, they're in great shape. But what we want to do is understand how resilient is this plan to potential future changes. So what if rates aren't 4.4%? What if they're lower or higher? What if they're variable, as they will be, and the client has a really poor market performance right as they look to retire? For that, we can go to the stress testing, and that's an optional paid add-on that's available in Snap, which provides access to the Monte Carlo tool, randomized scenario, and historical scenario. These two tools are outlined in more detail in our Help Center. Today we're going to be focusing on the Monte Carlo analysis. Once I open the modal, I can click Calculate in the bottom left, and Snap is going to start running through 1,000 potential rate sequences that John might experience in the future. So this is going to look at what if inflation is high, low, what if returns are high and low, what if they're really strong early in the plan but weaker later. It's going to give us a sense of how resilient John's projection is. And as it runs through the 1,000 calculations, we can see how many it's done here. It's giving us a summary of the results calculated so far. We have the most common metric that people are familiar with when they run Monte Carlo, that's the success probability. This is calculating how many plans are expected to have a surplus goal balance or a shortfall. The goal balance in Snap is defined by the client's financial assets, their personal financial assets, less any taxes payable on those assets, less any cash that has had to be borrowed to fund spending. So if the client has run out of money or if the software can't access their money for any reason and it needed to borrow to reach their spending goal, then that gets subtracted off of their available resources. The goal balance is then determined whether it's positive or negative, and then the probability of success is how many plans have a positive or $0 goal balance at the end. We can also see what the goal balance is expected to be across the potential future outcomes. So at the 50th percentile, that's the median case, John is expected to have about 1.2 million. So 50% of the time he'll have more than 1.2 million, 50% he'll have less. And that means that he has about 26% more than he needs for his target spending. So his total resources are 127% of what he needs. If we move to the conservative case, where we're at the 25th percentile, this means that 25% of scenarios will be worse, 75% will be better. In that scenario, he's at about 164,000 of surplus buffer. And then in the pessimistic case, the P5 scenario, he has a shortfall of about 800,000. So this helps us to understand not only how frequently will he be successful, but when he's not successful, what is the magnitude of that potential risk? The tool is done calculating, so all of the results are no longer moving. We've got our final numbers, and now we can analyze the remainder of the charts. The success probability chart is just this information, but for each and every year of the plan. So this top summary is for the final year. This is 80% of scenarios are successful as of the last year of the projection. And then we can see how that differs over time in the plan. So as of age 73, that's when the first plan could potentially have a shortfall. And then by about age 87 is when they're at a 94% success rate, and then it gradually tapers off. If we scroll down, we can also see the goal balances chart. So this shows us what the client's goal balance is expected to be over time across the different percentiles. So if we look at the very end, at the 5th percentile, that's the one that's summarized at the top, he has a shortfall of 827,000. On the optimistic side, the 95th percentile, he has a positive goal balance of about 7.8 million. We also have the worst and best case included just in this pop-up box. We don't have it as part of the chart because it would significantly skew the y-axis, and it would also draw a lot of attention to scenarios that are very unlikely to happen. But we can see the best and worst here. So worst case scenario, he has a shortfall of 2.3 million. Best case, he has a positive balance of 26 million. So it just gives you a sense of, yes, he's on track, but there is uncertainty in the plan because of the volatility of market returns. All of these charts are fully interactive. So if you click on any of the lines, you can add, remove, and really focus in on any particular area for analysis. Continuing down, we also have a chart for financial assets. So this is a bit simpler than the goal balance. This is just looking at the client's gross personal financial assets. So how much do they have in their accounts throughout the projection? Then we have the estate after tax. This is helpful to understand everything that's happening in the plan. So this brings in real assets like their home. It brings in any surplus corporate balances, and it looks at everything in the plan, net of tax, what's left over at the end. And if we look at that for the end of this projection, we can see that at the 5th percentile, they actually have a positive estate after tax. So they have 435,000 left. And that means the 800,000 shortfall could actually be covered by equity in their home. So even though it looks like they have a shortfall, if they're comfortable using their home towards that, they might be able to weather those particular circumstances. And then the last chart is the shortfall probability. This is telling us whether there's any pink shading in the underlying scenarios. So on the planning page, when the client needs to borrow money to meet their spending goal, Snap highlights that section of the plan in pink shading. Because that information isn't available to you from this modal, we want to bring that transparency through with this chart. So here we're showing you what's the probability of pink shading and the client needing to borrow within the plan. This can help you to understand whether there might be cash flow challenges early on, or why are they running out of money? Or why are they failing their earlier plans? It's because they're needing to borrow. They've run out of financial assets and they don't have anything remaining. So that's a high-level overview of the Monte Carlo. Once you're finished with the kind of high-level stats, you do have the option to dive into any of the sequences by going into Randomized Scenario. So if you click Randomized Scenario, we can actually review the underlying rate sequences. So here we have the 50th percentile. So Snap has ordered all of the potential 1,000 scenarios from worst case on the left to best case on the right. You can jump across the scenarios very quickly from the bottom left, or you can relocate the bar on the slider. In this case, we have the median scenario, which has a goal balance of 1.2 million, and we can see what the rate sequence is that's causing that. We have fairly reasonable equity returns, fixed income is above inflation, and cash is a little bit below inflation on a long-term basis. So a very reasonable, very realistic outcome. If we look at the pessimistic case at P5, this is where we're going to see things like, fixed income actually outperforming equities. So this is a really poor performing equity scenario. And as a result, our returns are quite a bit lower and we get that negative nominal goal balance. So we've had to borrow money in this plan because of the rate sequence. Beyond just looking at the rates themselves, we can go a step further and actually apply those rates to the underlying scenario and really dive into the numbers. So here we can see the variability of inflation. We can see the rates of return being applied to the plans. And as we scroll down, we can see when they're expected to start running out of money. We can see that pink shading. We can see their cash balance is negative and they're borrowing money. And then they have a total shortfall of 827,000. So you can go all the way from a high-level summary of all 1,000 scenarios through Monte Carlo down to the most granular information on any of those individual scenarios using Randomized Scenario. The two tools are also linked through the assumptions that underlie the sequences created. So if you click Show Fine Print at the top of the randomized scenario modal, just going to scroll down, that's going to open up this table underneath the chart where we can see the expected rates of return and deviations that are being used to create the 1,000 scenarios. So if you wanted to modify either the average rate of return or average inflation rate or the standard deviations used, you can adjust those here, and then you'll have to recalculate the Monte Carlo using that new set of randomized returns. So there's lots of flexibility. You don't need to dive into all of this right off the bat. You can really come into Monte Carlo, click calculate, look through these numbers, have a discussion with your client. And the primary opportunities that Monte Carlo is intended to open is to understand, are they comfortable with an 80% success probability? This doesn't mean that they're going to fail in 20% of cases, because the point is to adapt over time, to review the plan, recalculate their Monte Carlo as things progress. And if they're trending down one of those poor paths, if we go down here, if they're more on the pessimistic side of things because their rate sequences have been lower than expected, then you would talk to them about potentially scaling back their spending. But if they're on the favorable side of the potential outcomes, they don't need to make any changes. They might even be able to increase their spending while still leaving a buffer in the plan. So we want to be constantly revisiting these plans and updating them over time as we learn more about the actual rates that they're experiencing throughout their lives. What a reasonable target success probability is depends on the client's circumstances. So for some clients who are very open to adapting over time, they're comfortable dropping their spending if needed or selling their home, they might be good with a success probability of 50% today. Because again, it doesn't mean that they're going to fail 50% of the time. It means that they're going to need to make a change in the future 50% of the time. And that might be fine for them because in 50% of cases, they won't need to make a change. And if anything, they can potentially increase their spending. So depending on whether the client is trying to maximize their lifestyle throughout retirement, or maybe they're really risk averse, that person might be leaning more towards a 90% or 85% success probability just because they don't want to have to make changes. Maybe a lot of their expenses are fixed and they can't reduce them if they need to in the future, or they don't own a home. There's no buffer in the plan to be able to weather those downside. They might want a higher degree of success at the start. So that's the Monte Carlo tool. We hope you enjoy it. We're looking forward to any feedback, and we're looking forward to providing more tools. If you go into the help site, you can find dedicated articles, webinar resources on our help center in order to make sure that you're fully comfortable and utilizing the tool to its fullest potential. Thanks and have a great day.